All right, so we come back from the weekend and kind of in the same mode that we were before the holiday, and really pretty much how we've been almost every day, except for the Nvidia earnings day where we gapped up, as from a market standpoint, gapped up and had an engulfing pattern. Now every day since has been pretty much been a Harami pattern, which is kind of a reverse engulfing where everything we've been stuck inside that range for over a week now. But that's the market, right? Low ranges, low volumes, low volatilities. Except for today, things today weren't necessarily the same as they had been. There was a few outlier movements, volatilities continuing to ramp up, a few asset classes making some interesting moves that don't necessarily align with continued risk appetite, as well as some interesting patterns in sector rotation. An obvious pattern and then not so obvious pattern that usually should go with what we're currently seeing, and we're not. So we'll break all that down: the sector rotation, the asset class performances, what's driving this move. We all pretty much know it's a four-letter stock that's driving the markets right now, and we're actually kind of getting a pretty good idea of what the market would be like if the Nvidia didn't exist. So I'm going to break that down and show you what's kind of where we're getting that picture from and what it's telling us. And then our trade idea is a stock that's in that chip sector, that's kind of participating indirectly from the Nvidia halo effect, and we'll talk about how to trade that stock. So let's go ahead and get started. Today is Tuesday, May the 28th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching this here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. So I review old trades, see whether we should stay in them or get out of them or not. Come down to the bottom, click this heart. It opens up, let's see, you click on that. It opens up this tab. Hit that like button there, right there. Same thing here. Click on this thumbs up icon. It opens up this tab. Hit that like button there on that. Again, the more you do that, it helps get our content out to all of our followers on these platforms. That's why it's a big deal for us. That's why we always ask. So thank you to those who click on this day in, day out. We really appreciate that. Those who don't, you can do it right now while you're watching with one or two really easy clicks, and we can get to our 100 like goal on our Market Outlook tweet. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. As you can see, another day where we're just kind of messing around this 5,300 level. It's a 1, 2, 3, 4, 5, 6, 7, 8, ninth day in a row that we've traded up and down, above and below the same 5,300 level there. Very sideways and pretty much inside of the Nvidia day range, right? The first 6 days are inside the Nvidia day range, and the last 2 days are inside the Nvidia day range. The intermediate line remains strongly bullish. It's still up. In fact, it's still above the 90th percentile, much less in the upper reversal zone. The market sentiment is falling, but though it's still in bullish territory, right? It's not falling precipitously, nor is there any threat of it turning bearish anytime soon. The near-term line bounced out of bearish territory after the Nvidia announcement. We have now come out of bearish territory. Now we're not in bullish territory yet, and nor did the momentum line make its way into overbought territory. So it doesn't look promising for the near-term line to make, unless we can get a good, strong breakout move above the Nvidia day highs sometime this week, which will probably take the momentum line up above the 80th percentile. Then we'd feel good about the near-term line getting up there and staying up there for a while at least, so that we can maintain the bullishness. As of right now, it's near-term line still in neutral areas, and momentum line, because of the smaller range today, of course, every day is a smaller range except for the Nvidia day and except for the CPI day. Every day has been way below the average, and that continues to be the case. We are still above the 2.5% mark, above the 30-day moving average, but that's going to start, unless we start moving higher, that's going to start to decline. And so we'll see how much longer we can maintain this pace. Of course, your NASDAQ 100 is going to look very similar. I don't know why it's all jacked up here. Let's take a look at the Qs. There we go. So we are at the upper end. It was a lot more bullish today, so we are at the upper end of the Nvidia day range, so we're still inside of it. Again, small range, just like normal, and you can see the near-term line getting into at least close to the upper reversal zone, even if the momentum line didn't quite get there. You are almost 5% above, so a little bit more bullish on the Qs. On the other hand, the Dow Jones is a little bit more bearish. The intermediate line is falling pretty strongly. In fact, we've almost got a bull tag. Like, that's how close we were to finishing. We were 0.08 of a percentage point above the 30-day moving average. That's how close we got to getting a bull tag today. A bull tag being across, across below a light pink shading yellow line with a close below the moving average. So we didn't quite get that. The short-term sentiment strongly bearish, continues to be strongly bearish today after pretty much the last so many days. So the Dow, a price-weighted average that doesn't have NVIDIA in it at all, and you can see, this is pretty much kind of showing you what the rest of the market's doing outside of NVIDIA, because again, there's no exposure at all to it here. Though there is exposure, of course, in the Dow Jones to Apple and to Microsoft, just not NVIDIA. And let's take a look now at the Russell 2000, and you can see it's also looking a little bit more bearish. Though again, we're not below the moving average. We're not breaking down. It's barely. It is light pink shading. We are, the intermediate line is below the 80th percentile and falling, so that we got the light pink shading, but we're also not necessarily we're not even close to the moving average. We're still over 1.5% above the moving average. So there's no bull tag threat there. Remember, the bearish runs start with a bull tag. So we have to at least get a bull tag first before we even consider the potential for weakness here. And obviously there's no threat of that happening yet. The intermediate line's well above market sentiment. Now that the intermediate line is between the reversal zones, now we need to pay attention to where the near-term line is. So for us to kind of turn this ship around and get back to the bullish posture, the near-term line's got to cross up above the intermediate line and ideally get in the reversal zone. Same thing with the Dow Jones Industrial Average. It's the near-term lines, the intermediate lines between the reversal zones, so any near-term line cross will be significant. Now that it's below it, you would need to cross up above it to really turn this thing around. It's also the one that's closest to falling below its market sentiment, which is lower than where the S&P is. Remember, market sentiment is still in bullish territory and is barely falling. Well, that's a pretty, we're starting to pick up some pace here to the downside, though we are still at least in the upper half of the chart on the market sentiment line. Let's take a look at the weekly chart for the S&P, and you can see now, now last week we had a slight crossover to the downside of the green line below the purple line. So the green line is the size of that body, the candle, the Hakinyashi body up there, and the purple line's a 3-day average of that green line. So we've crossed over. We have a crossover of that 3-day average. So in other words, the body's starting to get smaller. Still a higher high, right, by just a couple points. We obviously don't have a higher close. We don't have a higher high yet. And the PPO is still relatively bullish, though it's kind of flat. It's in the 87th percentile of the past year, so it's still pretty bullish levels. You'd have to, really start to break down, like say below the 60th percentile before you need to, again, start worrying about us being in bearish levels right now. So not in bullish levels. At least start even thinking about potential bearishness. So I think we're okay there on that. Let's look at the 3 green arrow chart. You obviously do not have 3 green arrows on the Dow Jones or the Russell 2000. They're both showing 2 red arrows. The S&P finally has shown a red arrow on Friday on the MACD. It still only has the 1, and it's still barely red. The MACD is, remember, the MACD is almost always first on the red arrows. The NASDAQ, however, is still 3 greens and still going strong, well above its moving average. So you can kind of see, again, what kind of market we're in here. Looking at the 2-line version of this, the S&P is in convergence mode with that red arrow on the MACD. It kind of signals a convergence mode here. You are still above the 8 and 17-day moving averages. The diamonds, remember, you broke down below. The MACD's histogram is definitely a red arrow. The stochastics is also down, out of bullish territory, not quite in bearish territory yet. And you can see you have, you're well below the 17-day moving average. So a lot more bearish picture on the Dow than what you're seeing on the S&P. Even the Russell 2000 is flirting more with that 17-day than what you're seeing on the S&P. Though a lot of support. So again, not that I'm suggesting we're going to be down, but it kind of just shows, the weakness of the bullishness that we're having. It's not necessarily a, hey, let's back up the truck here. Unless you're buying NVIDIA, this is not a back up the truck moment for the markets, to say the least. And then mostly because of the lack of like the volume and the trading range. We'll get to that here in a second. Let's take a look at some of the other oscillators here. You can see the DMI is still positive. You're still above 25 on the positive indicator, below 20 on the negative. That's still positive for the S&P. Your Dow Jones Industrial Average, that's not the case. You're above 30 now in the negative indicator. You're not quite below 20 yet on the positive, but that's a bearish crossover there. Looking at the RSI and the CCI, still at bullish levels for the S&P across the board there. But looking at the Dow Jones, and it's not at bullish levels. In fact, you're kind of inching towards bearish levels, below minus 100, almost below minus 150, and then again almost below 40. So things are much different picture for the Dow, again, which does not have exposure directly to NVIDIA. Let's take a look at the Ichimoku cloud. You can see we're still above the green line on the S&P, positive rate of change, well above the cloud. You have intermediate trend strength there. Great, right? Good picture. The Dow Jones, you're below the blue line, just barely, but you're still above the cloud, but you're below the blue line. You still have a positive rate of change, and you have weak bullish trend right now. Like the numbers have gone down the weak levels. We'll see if this turns out. It's not so bad when it kind of slowly works its way down. It's worse when it just like you have a sharp drop down to zero. That's usually when you're worried about the trend. So that's a good sign that we're not like dropping straight to zero on this weakness. It's just kind of, we're still bullish. It's just very, very, very weak bullish trends here. And then looking at the Bollinger Bands, the S&P is still in the upper half of its chart, not above the upper Keltner channel anymore, and you got some weakening momentum down there. The Diamonds, again, is in the lower half of its Bollinger Bandwidth. Its bandwidth still way outside the Keltner channels, and you're actually pretty darn close to getting to the lower channel, and your momentum is dropping a lot sharply. So, a little different picture there on the Dow Jones Industrial Average. If you look at the weekly range, we're still easily in the upper half. Again, inside days. The last week's range was the NVIDIA day, and as I told you, since the CPI day, including the CPI day, we've been inside the NVIDIA days range the entire time. That continues to be the case. You still have a pretty decent, you're still above 5% on the width of the channel, though that's going to start dropping. Like, it'll take a few days. By the end of the week, you're looking like the low of the 4-week range will be up here. So unless we start getting some pretty significant new highs, then this range is going to drop pretty sharply. And then again, because we haven't had new highs, the more this moves over to the left, then the more this green line drops below 70, and now we're susceptible to a change in direction, which, again, if you look at the diamonds, you can see we have done that, right? We have dropped below 70 because the high has moved way over here. We are in the lower half of the chart now, so when you look at this chart here on this time frame, you can see we are below its moving average, below 50th percentile, though just barely. We'll see if we build on that or not. So things are dramatically different there on the diamonds than what we're seeing there on the S&P 500. I mentioned to you today's range and volume, very, very low again, 36 million shares trading hands, 3.4 points, so both below average. The averages are really small to begin with, but 3.4 is way off the chart down here for the ATR. The volume at 32 million is way off the charts to the downside. So the averages continue to drop pretty sharply on both the ranges and the volumes and volatility. You'll notice volatility is also relatively low still, below 13 on the VIX, below the 90% mark relative to the VIX 3M. The VVIX is down a little bit, or has been down a little bit off its peak from a couple days ago. It's still above 80, right? So these, you can see we're starting to move higher. In fact, they're both starting to move higher as the correlation returns back up to its normal positive levels. Kind of like what we talked about last week, there's an increased odds that both of these will start to trend higher. As you can see, the VIX is flirting with getting above its average values over the past 17 days, exponential average value of the last 17 days, and that can start to change the momentum for the VIX. It doesn't have to spike higher, but it starts to at least trend higher when you get up, above those levels. All right, now let's take a look at what's driving this price action here, and you can see, of course, you don't see it on this chart, but obviously Nvidia is the main driver. But interesting on this chart, as you can see, is yields were up and commodities were up. Remember, commodities had kind of decoupled from yields here recently. It was yields and the dollar that were still the remaining two heads of that three-headed monster. Well, commodities made a big ramp up today, up almost 2%. Gold is up 1%. There was some weakness in the dollar, though, off the lows, but yields were up quite a bit. If you let's look at TLT. Let's see if they've updated. They hadn't updated TNX yet. Let's see if they have here. No, they still haven't updated. So let's look at TLT. That's a pretty significant drop below the 17-day moving average. MACD is obviously negative. Stochastics is now out of bullish territory. So we have now ended the bullish run, at least according to those oscillators. So that doesn't necessarily mean that it actually is over, because nothing's 100%. But if you look at all these, above 30 in the positive, you're still not below 25 on the negative. When you look at the RSI and the CCI, you are now below 50, still not below 40 yet, below 0, but not below the minus 150 level yet. That you look for. If you look at the Ichimoku cloud, you are back below the cloud. We did not finish. We don't have a trend anymore, so we lost our trend. And then when you look at the Bollinger Bands and the Keltner channels, you are in the lower half of the chart, though not in the lower quartile yet, and momentum is declining. So that's a pretty clear shift in direction on TLT, which means that bonds have the potential for starting to move a little bit higher. Now, again, you notice that was not the case on the dollar. The dollar dropped, though it didn't drop from the open. It dropped from the open, but rebounded off of the today's lows. Ended up finishing a little bit higher than where we opened today on the dollar index. In fact, if you look at the dollar relative to all the other currencies, let's just look at today. Remember, there's the main three currencies that in the dollar index is the yen, the pound, and the euro. Well, the dollar was actually, the euro was down against the dollar. The yen was down today against the dollar, and the euro and the yen and the pound. See, the pound is the yellow line. That was down. So the dollar was up today, or dollar was down today, but really wasn't. If I were to go back to the weekend, you can kind of see. Let's go back to the 24th. So again, you can see here from this would be the 27th. From this point over, let's see here. This would be the 27th in the morning. Let's go to about right in the afternoon. You can see that's kind of, we go from 2 to 4 right here. So this is kind of when the day starts, and you can see now the euro is up against the dollar, or you can see the euro is positive here. Well, it's about flat. It was up most of the day. It ended up being flat. If you notice where the yen, the dollar actually was up against the yen. The pound was pound was up against the dollar from the beginning of this period, and then dropped a little bit here late at the end. So not quite the move on the dollar that you're kind of worried about. Because remember, a rise in the dollar is not good for risk appetite. At least hasn't been here lately. So the fact that the dollar dropped is good, but the fact that it didn't break the 200 is not the greatest, right? If it can break that 200 and really get going to the downside, then we can really get going to the upside in the S&P 500. It's kind of one of the things that, and yields rising has kind of been a limiting factor for the strength, and really the only thing that's allowed the market to have any kind of strength has been Nvidia and that post CPI report that we've had. If you take a look at the sector moves, this is kind of an interesting chart that I tweeted out here. This is the relative strength chart off of stockcharts.com, the RRG chart. There is only one stock, one sector, excuse me, that is outperforming the S&P in the leading category that has both strong momentum and strong relative strength. There's, you can see utilities has also been outperforming, but it's been losing its momentum to the, down here to, in fact, it's got the lowest momentum out of all the sectors, though it has, again, the most relative strength outside of technology out of all the sectors. That's how strong utilities has been. But you only have 3 sectors that are not in the lagging category. So all these sectors are underperforming the S&P, and they're not just in the box, but they're moving down to the left, right? And moving down to the left will keep them in that box. XLC is not really moving very much at all. It's barely above 100, and it's really not moving. So, this has been an all technology. In fact, that's the other thing that I retweeted out from Samantha LeDuc here. That, and again, this is from the last week, over the past week, ending on Friday, and you can see technology is pretty much the only gainer. A little bit of a gain in XLC, but everything else down over that period. So this is, again, you can kind of get the picture that we have one big driver in the markets right now, and that continues to be NVIDIA, right? You can see NVIDIA right here, up 7% today. In fact, when you look at its DMI, let's look at its DMI for NVIDIA. It's well above 40. It broke up above 40 in a big way here as we head towards that 10-for-1 stock split. And your negative indicator is almost back below 10. It's not quite there, but it's almost back below 10, just like that. So again, this has been the big driver of what's going on. If you look at it, on his Bollinger Bands and his Keltner channels, it is way outside his Keltner channels, like way outside that. It got up above it on earnings, and it's been way up above it since. It's been outside its Bollinger Bands for the last 3 days to a very large degree, not even just to a little bit right here, which is kind of sustainable. And it's not like we're coming off of a bandwidth that was really low and you break out and you're able to now maintain a trend. Like, this is a breakout when we're already pretty bullish. It's a bandwidth's down a little bit, but dang, that's a big move up. You can see the momentum over here, the highest momentum it's been all year long. If I were to zoom out a little bit so we can see some perspective, there's the highest of the last 5. Again, this is not apples to apples. You can tell it's obviously gets bigger as the numbers over here on the right get bigger, but still, you can tell that we are very strongly bullish on NVIDIA. Look at its RSI and its CCI, well up above 70, almost back above 80 again on the RSI, well above 200 on the CCI. In fact, if you look at the weekly versions of both of these, you're almost at 80 on the weekly RSI, and you are way up above. The last time we were this high was when we kind of had this breakout move over here at the end of May, and this is hardly a breakout move here this week, as we, after one down week here a few weeks ago, we've been up pretty much every week. In fact, you can see we've only had 4 down weeks out of pretty much this entire year. Every other week this year has been an upward week. It's just that one period that we were kind of slightly bearish, and then one down week that was in mid-April that was immediately reversed the very next week. So obviously this is the big driver in the markets. It continues to trade up well above, near the 100th percentile in the 4-week range. Even its average is up to strong levels. So very, very strong moves. And because of that, we're seeing weakness in breadth. Like, look, we're at minus 35 on the McClellan oscillator. If you look at some of the other breadth indicators here, let's go to some of these other breadth indicators that we like to look at. Let's look at the Qs relative to IWM. And you can see that is up again today. Not to its all-time highs, but it's up again today. It's let's see here. Yes, I would say we close here at 2.243, and today we close at 2.240. So that's how far off of the highest close ever that we've had. This was 2.238, so it's the second highest close that this ratio has ever had. You can see its PPO is getting up to high levels again. Its long-term PPO is turned up above its moving average. Everything else is pretty darn bullish. In fact, its CCI is almost up at 70 again. as the ratio is turning back to a positive correlation with the S&P. But the problem is, again, looking at some of the other ratios of risk appetite, you can see discretionary is not outpacing staples, right? That, unfortunately, we're not seeing that. Financials versus utilities. Whoops. Let's try that again. Which is another one that we've been looking at here lately. Has also not necessarily, I mean, you can see it broke below its 200-day, is continuing to break below its 200-day moving average. So we're, outside of XLK, risk appetite is actually struggling right now. We like to look at, here's obviously XLK relative to the market. XLK, let's take this back again. Apparently can't type. XLK relative to the market. You can see, okay, pretty bullish. Back above its 200-day moving average, rising, looking good. XLC relative to the market. Okay, still holding above its 200-day moving average, not really breaking any other major level. XLY relative to the market, and we are way below the 200-day moving average and breaking down hard, right? In fact, if you look at it on a weekly chart, you can see we are well below that. We never really have gotten back above the 200-week moving average. So you could say XLY is in a bear market, right? Because that's how we define a bear market, is being below the 200-week moving average, and continues to really, really be bearish. Now that, again, you have a negative correlation with the markets, and that hasn't stopped the markets from going up, but it kind of goes to show, we're not being driven. The markets are being driven by consumers right now. It's being driven really by this kind of AI trade, and obviously anything associated with that. Here's your number of stocks above the 50-day moving average, continuing to drop down below 220 now, down to 218, well below its average. Obviously, the number of stocks above the 200-day moving average lags a lot more, but it's also below its moving average. Those tend to be bearish signs. The skew jumped up to 155 today. The skew has jumped up to 100. So that, again, this measures fat tail risk. What this measures is that the market is not just worried about downside, it's worried about big downside. And so they're starting to, buy protection. I mean, look at that, the MACD for this, jumping up to very, very, the last time we kind of jumped up at least this high was pre-COVID, when we were up to this level. You can also see kind of over here, going into the summer, we had a big jump in a short amount of time, up to 3 or higher on the PPO. So that's a big, big jump. The market is concerned about something. Right? Being above the average is actually a good sign, but being up to this high level is not necessarily a good sign. And you look at the number of stocks, that have new highs and new lows. We are back above 100 today, so that's positive. We were briefly negative for a day last week. We've been in small positive levels since, but at least we're up to 101 today, still below the average, which is at 180 right now, which is not good. But at least, hey, we're positive. We haven't broken down too hard necessarily yet. And one last chart to look at before we look at our trade idea of the day. You look at this is the dark pool index combined with the gamma exposure for market makers here, which usually peaks when the S&P peaks, and you can see we did get a peak here. We got a peak over here. This peak started the convergence period, so ultimately led to a new leg higher, and you get the idea. You get these strong peaks, near peaks in the S&P. That's typical, right? That's when gamma exposure at its highest. Happened to be over here going into May expiration. Since gamma exposure has dropped off pretty sharply here, and so is dark pool buying. Dark pool buying is at one of its lower levels. In fact, usually when it gets this low, it means that we're kind of down, like we've had some pullbacks here. This is a pretty interesting drop for gamma exposure when we're technically not down very much. We're still at the same levels. So it kind of goes to show, again, there's not a whole lot of broad buying here. It's whether it's retail, whether it's behind the scenes, whether it's different sectors, whether it's a broad move in sectors or different asset classes that are associated with risk appetite. It is basically just NVIDIA. I've seen Brandon, my partner Brandon Van Zee, posting on Twitter about the vacuum, about NVIDIA being a vacuum last week when it had its earnings. And again today, right? It's basically sucking up all the money right now and taking it away from pretty much every other asset class / important equity that's out there right now. One of the but not in the chip sector, and that takes us to our trade idea of the day. If we take a look at AMD, AMD has got a really good looking market forecast chart here. As you can see, we got dark green shading and the green line. Now, the near-term line is not broken above the intermediate line, but we are over 9.5% above the 30-day moving average. So we got a good strong move there. The weekly chart's looking positive. We've had a couple weeks now of some bullish candles. I mean, not great, but we still are above the average. It's not the greatest size. You can see there's been other stronger bullish moves to the upside, but at least it is bullish, and at least you are breaking above the 50-day moving average, breaking out of the value area. There's still some volume in this area, so there's still some room to work with. But the MACD is positive. The stochastics, though below its moving average, is in bullish levels. If you look at some of the other oscillators, like the DMI, showing relatively bullish patterns above 30, almost below 20 on the negative indicator. The RSI and the CCI are at bullish levels, above 60, above 100, already having broken above 150 earlier. Looking at the Ichimoku cloud, you can see we are into the cloud now, above the green line, which is above the blue line. We got a weak bullish trend developed down there. If you look at the Bollinger Bands and the Keltner channels, we are in the upper quartile of the bandwidth. Bandwidth is increasing, and outside of the Keltner channel, the momentum is increasing, and we're pushing up against the Keltner channel as well. So pretty good opportunities, though, as I mentioned, not the strongest surge higher. And so what I decided to do here is just to play it more safe and do a bull put spread, selling the 162.5, buying the 160. Remember, we've already put this on in the Market Outlook Live video. So now, as long as it stays above this 162.5 level, there's your break even. If it were to break down below the low point from a couple days ago, then of course we don't want to be bullish anymore. It'll start breaking moving averages and all that. And that's why they have a break even there. And I'm willing to lose up to 396 on this trade for a near full position size. So we're down just a little bit here, and that's how much we're willing to let it keep going down. Otherwise, if it just kind of stays higher or grinds higher, then time decay will make up this, will bring that purple line right up to that green line. Alright, well that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.